Hi everyone, today let's talk about the wheel strategy. First, I will do an explanation of what exactly the wheel strategy is and how I plan to execute it. Then I will briefly talk about GE stock, which is the company that I have decided to wheel for the entirety of 2021. And to finish out the episode, of course, I will look at my position in GE right now. If you like trading stocks and options and making money, definitely like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So let's start off with what exactly the wheel strategy is. The wheel strategy is a way to generate semi-passive income with relatively low risk, but the main piece here is that we are trying to do this consistently. Account size is pretty important when it comes to the wheel strategy. You have to make sure that you have enough money to execute it completely if necessary, and I'll explain more about what that means in the next section. So the first step for the wheel strategy is picking a stock, and the most important part of picking a stock is that you are willing to own at least 100 shares of that stock, and that you are generally bullish, or at the very least neutral on the stock, and that you have enough money to own 100 shares of that stock. The first step of the wheel strategy is to sell a cash covered put, meaning that you are putting up the full value to own 100 shares of the stock at your given strike price. So you are selling this put naked in order to acquire these shares. In the ideal case, the stock rallies and you keep 100% of the premium and you don't have to actually purchase the shares. But of course, it doesn't always go that way. So we have to take steps if the stock goes below our strike price. We also have to balance out whether we're going to assume a little bit more risk and higher premiums, or if we want to assume a little bit lower risk and get lower premiums. They suggest that the premium should be at least 1% of the stock price, and any premium lower than this is generally a waste of time. Step 3, they say here, is to continue to roll this put out in time until we are eventually assigned the shares, which allows you to lower your overall cost basis each time you roll out that put option. Eventually, your contract will expire in the money and you will be assigned those shares. And then at that point, you sell a covered call in order to receive more premium without putting any more money at risk. That covered call is agreeing to sell the shares, ideally at a higher price than what you were assigned for. And if the stock rallies, then you get to sell the shares for a profit. And if the stock goes down, at least you reduced your cost basis and you're not losing money purely on the shares. You make a little bit of money on the covered call. In the ideal case here, the stock rallies, your shares get called away from you as the call option expires in the money, and then you start over at step 1. If you want to continue with this stock, you can do so, and then you sell a cash covered put and go again. As I mentioned before, the stock that I have chosen for this experiment is GE. You can see here in February, the stock was valued at around $13 per share. At its lows for this year, it was valued at around $5.50. And since then, the stock has rallied all the way up to $11.50 and has since retraced back down to $10.80. The fact that this stock is in the $10 range means I only have to put up around $1,000 to own 100 shares, which makes it in the ideal range. If the stock goes down, it's not a huge loss for me. And I do believe that GE at this point does have a little bit more upside as the Rona comes to a close. And the 737 MAX is back in the air, which allows its aviation division to start making some more profits. In terms of technical analysis, I think there's some support down here at around $8.50 on the daily chart. And at the very lowest here, I think I see a price of around $7 per share. And if I roll this out for the entirety of this year, I think I will be able to turn a little bit of a profit. So let's look a little bit at some of the analysis of GE right now. They start off with saying the 737 MAX is back in the air, which is of course beneficial for GE. The manufacturing giant is finishing off 2020 pretty strong after slumping to its lowest lows since the financial crisis. They say in terms of technical analysis, GE broke out of its $8.67 buy point on November 9th, and it's currently above its 50-day moving average, but it is above the $9.10 range, which they are saying here is the buy range. The 200-day moving average is also trending up. So to me, this says it might be a little bit overvalued right now, but the trend is in the right direction. And you can see that here. So we have the relative strength index, where we're a little bit above what they're calling the buy range, but at least the indicators are going in the right direction. They say the IBD composite rating is 36 out of 99, which is not great, but the RS rating is 80, meaning it's performed better than 80% of stocks over the past year. They also seem to think that it's getting some pretty strong institutional buying over the past 13 weeks. Looking at some of the fundamentals, the earnings per share is 11 out of 99, which gives it a C rating, which is not great. And its pre-tax margin is 7.6, also not that great, as the minimum that investors would like to see is 17% or higher. Earnings per share for 2020 dropped 60%, and sales dropped 17%, which was actually better than expected, but of course these are not great signs. They are expected to turn a very small profit for all of 2020 at 4 cents per share, which is down 94%. However, they are expected to return to better profitability in 2021. Out of 8 analysts on Wall Street, 4 have it as a hold, 4 have it as a buy, and none of them have it as a sell. The aviation section of GE is their most profitable section and has obviously been heavily impacted by the Rona as well as the 737 MAX situation, but it seems like both of those are turning around at least a little bit and should continue in the right direction. The conglomerate is also going through a pretty substantial restructuring as they have cut off pretty significant numbers of their businesses and are focusing on strengthening their 5 core businesses. And this transition was obviously heavily impacted by the Rona, so it should be interesting to see where this goes in the future. Despite all of this, they continue to pay their chief executive pretty exorbitant bonuses at $47 million right after they lowered their share price target for him to receive that money. They say as long as GE is trading above $10 per share, he will receive $46.5 million in 2024, which seems pretty exaggerated for a company that is really struggling right now, and they have laid off a pretty significant number of workers. The current bonus plan is for him to receive a maximum of $230 million as long as GE shares stay above $16.68, rather than the $31 per share that was originally agreed to. So they cut the price target nearly in half, and they're still going to pay him nearly $250 million. Seems like they could use that money to grow the business or help with the restructuring or literally anything besides this, but it's definitely something to keep an eye on. Despite all of this, GE is outpacing the market right now, and I don't really think this is because of their strength. It's more because they've been beaten down so heavily and they haven't recovered the way the rest of the market has. But it's still a bullish sign, and it's something that I'm paying attention to. In this article, they mention a lot of the same things as the other analysis article, but you can see they have a little bit slightly improved reported earnings for the year at 8 cents per share, which is still a year-over-year decline of 61.9%. Again, not great, but better than expected. Something that wasn't mentioned in the previous article, and they didn't mention it in this one either, they also announced a 1 cent per share dividend, which means they must be going in the right direction if they feel comfortable enough to announce a dividend despite all of their financial difficulties. Moving on to my actual option position, getting started on this wheel strategy, I sold the $10 puts for 41 cents per share, giving me an effective purchase price of $9.59. And you can see it's already in a $2 profit here, with the market value being 39 cents. I am actually not following the wheel strategy exactly. I did purchase the $7 puts here for 3 cents. And this caps my max loss if GE was to fall through the floor unexpectedly and it fell below $7 per share. This would cap my loss at $200.62 because I received 41 cents for selling that original put, and I paid 3 cents for this put, which gives me a result of 38 cents credit. And my initial put was the $10 put. So there's $3 between the 10 and the 7, which is a $300 potential loss, but I received that 38 cents in credit, giving me that total max loss of $262. If the stock was to go down, I would roll this out in time, and I would probably remove this $7 put and treat it like a true wheel strategy. But this just gives me a little bit of insurance, and the way that these options are set up, it was only $3 to cap my max loss, which is definitely worth the value. And both of these contracts had an expiration of 19 February, which is currently 49 days until expiration. I took this position on Wednesday the 30th, and I reach out to the date that is closest to 45 days until expiration, which in this case was February 19th. Looking at the options here, you can see this gives me a 72% chance of profit here, which is right around where I want to be. I like to be close to that 75 to 80% profit. But I didn't want to go down to $9 because the credit is not quite enough here. and 83% profit's a little too high for me. I like to be in this range, so I went ahead and sold those $10 puts. And again, I mentioned I bought those $7 puts for $3. So go ahead and call it out in the comments. What's your prediction on the end of 2022 price for GE? Will I be able to trade the wheel strategy successfully and actually make profits? Or will this be a complete blunder and will I lose all $1,000 I'm willing to pay for this? This is the first episode in a series. I will be giving updates on GE stock and my progress in the wheel strategy, so definitely like and subscribe to keep track of how this goes. Of course, this is not financial advice. This is all for entertainment purposes, and have a great day.